Good evening, all. Quick disclaimer, just like whatever the investment ideas that we'll be discussing, it will just for the educational purpose and do your own research before investing. Today we'll be discussing about how we can leverage the India growth story for creating generational wealth. So just to give you a context of what we'll be discussing. So first I will be discussing about the India in terms of global context. Then I'll be discussing about the some key emerging trends and themes from India. And then my colleague Vijay will be discussing about demographic and consumption trends. And then he'll be discussing about some of the key themes that we have onboarded in our portfolio. So starting with the India context in the global landscape, so we can move to the next slide, please. Yeah. So understand, like currently today, we have we have an entire GDP of GDP close to $3.5 trillion. And if we add in another 500, $600 billion of GDP, which is in the parallel economy, so the total economy's GDP economy size is roughly equivalent to 4.2 trillion dollars, right? And if we compare that with what other countries have done in the past, when they are moving from, let's say, $2 trillion or $3 trillion GDP mark. So if we compare the past behavior of, let's say, something like China, so when it crossed the $2 trillion GDP mark in the next 4 years, from 2004 to 2008, the Chinese market have become 4x in 4 years. If you also look at US, what it has done, so basically it crossed the $2 trillion mark in 1978, and in the next 20 years, the US market has grown by 15x. Similarly, for Japan also, when it crossed the $2 trillion mark, the next 13 years, the market has grown by 14x. So basically, what happens that if a country moves from 2.5, $3 trillion mark, so there is some sort of differentiated consumption that happens in the country. And also, if the per capita income improves from 2.5, $2,500 per capita income mark, so there is also a consumption of certain different type of items which are more discretionary in nature that keeps happening at a very fast pace, right? So we have seen, like that happening with China. For example, 20 years back, when China didn't have any manufacturing base, they started with basic manufacturing, right? And if you look at the 20 years down the line, the growth of those industry, like manufacturing of electronic goods, so that industry, in fact, the key players in those industries like Foxconn, Jabil, or Sanmina, so those companies have managed to grow their top line by more than 50-60% for the entire decade, right? So when economy has started to have a differentiated sort of consumption, right? So it's a very big push for the entire market and also the stock market as well. Now compare that to India, right? So today, if you look at the past 60 years of data or 70 years of data, so India added the first $1 trillion in 60 years after independence. And to add another $1 trillion, India needed another 10 years. And if you look at the last $1 trillion, which is the third $1 trillion that we have added in just 8 odd years. So from here on, if you look at every 6-7 years, we'll be doubling our GDP, right? It means that every year we will be adding $200 billion to our GDP, right? What it means that is that all the mid and small cap companies which are emerging in the new sectors, like be it electronics manufacturing or let's say EV side or manufacturing of certain chemical products or something or other thing, right? So the market for those, or in fact the market for normal consumption items, right, discretionary consumption, consumptible goods, so the market of these items have been expanding at a very rapid pace. If you look at that, if you break the $3 trillion or $4 trillion GDP of the country, so every corner of the country, be it north, south, east, west, so every part of the India accounts for $500 billion to 1.25, $1.3 trillion of GDP, right? And that is in fact more than most of the countries which is there in the Europe or Middle East or in fact the Southeast Asia, right? And if you compare and go back 15 years, right? So if you look at the market size, is almost similar to what India's GDP was 15 years back. So it means that every corner of the country has now the potential size that we can expect some multi-baggers like HDFC Bank or Bajaj Finance to emerge out of there. So these stocks or these businesses which are operating at a corner and operating at a serving a very differentiated segment, so these companies don't need to be pan India play. The opportunity size in fact is bigger in their own corner, right? So basically, a company that we have onboarded in towards the which is operating in the eastern part of the country. So basically, it continues to expand its top line in the more than 30% CAGR, right? Similarly, the other company, we see that company to continue expand its top line by 20% CAGR over next 10 decades, over next decade, right? 10 years. So this is the kind of opportunity size which is available in the mid and small cap side because of the fast pace of the GDP addition. So we have a very good growth pathway ahead. Let's see, what it means from the international fund flow context. So if you look at the US market today, right? If you look at the yield spread, which is the difference between the 10-year bond yield versus the US 10-year bond yield, Indian 10-year bond yield versus the US 10-year bond yield. So it's at all-time lower level. In fact, the lowest in the last 10, 15 odd years, right? So if you look, what it signifies is that the attractiveness of the Indian market is actually way higher than that for the other global players or for that matter US market as well. So what is happening in US is today we have, I'm just giving a very current context of the market. So today they are following a monetary policy which is very tight, right? They have raised the interest rate rates to, let's say, 15 years, 20 years high, right, at around 5%. But if you look at, on the other hand, their fiscal policy, so in the last 8, 9 odd months, they have expanded their balance sheet by $1 trillion, and that is a very huge kind of expansion they have done on the balance sheet side. So what it does is, although they are doing a very tighter monetary policy, but the inflation will remain high for longer because they have a very loose fiscal policy, because they don't want the economy to collapse. They have done it in the past, in 6, 7 odd months back, when there was a banking crisis in US. So because of that, the interest rate will continue to remain higher for longer. Now, if the interest rate will remain higher for longer, that it means that the equity risk premium which is there in the country, right, it also has to go up. So if the 10-year GSEC is giving you a return of 6% and corporate bond is giving you a return of 8%, or home loans you are getting at 8%, then whatever the equity risk premium that you have to pay for owning equity is way higher, right? And equity risk premium, who don't know about it, so basically it's the risk premium that you pay for owning the risk of owning equity, and it covers all sort of risk, be it the default risk by a company, or let's say the currency risk or inflation risk, or business specific risk as well, or systematic risk in the country. So it covers all sort of risk, right? So if the equity risk premium goes up and remains up for longer, it means that the stock price will remain sideways for longer. So if some fund manager is sitting out of US and he has to bring alpha to its client, so US is not the ideal is not the ideal place for long-term point of view for investments. But since every fund manager has their own country bias, right? And by regulation also, they have to invest some sort of portion in their home country. So if they have to look at for geographies outside US where they can invest, so India is now emerging as a probable place where they can come and invest and reap good benefit out of it. So currently, the kind of growth of manufacturing products, plus if you look at the kind of demand consumption that we are having internally in the country, it's very strong. And the growth and demand balance is what makes a country very desirable from an investor point of view. So on that context, India remains a very strong investment case for any global investor. Now let's understand how equity market has behaved in the past. So if you look at the last 20-year data, none of the time period is there where Indian market has underperformed their global peers. So be it 3-year, 5-year, 10-year, 20-year data points, every year, every time frame, Indian market has outperformed their global peers. And this is the dollar return, right? So if you convert the local currency into the dollar return, and that's how the return you will be getting. So even with a 4 to 5% kind of annualized depreciation of our currency, local currency, we are actually outperforming all the other global peers, and in fact, the US market as well, right? S&P 500. So it means that India is presenting a very strong case, be it from the historical perspective, if somebody has studied the past returns, or from the future perspective, if they are looking for a growth prospect, right? Now, if you understand and try to understand and look at the allocation that can come to India from a global fund side, right, be it FIIs or FPIs. So typically, 1/3 of the investment is done by your pension funds and sovereign funds, and they have a very fixed policy that they will be allocating the share, whatever the share of GDP in the global GDP, right? The share of a country GDP in the global GDP. So let's say India's share of GDP in global GDP is around 3.5%. So they will be investing just 3.5%. Then around 66% of the hedge fund managers out there which are managing the money on active basis, but they also don't much change with the weights, right? So if the India share is 3.5%, they will overweight and make it 4%, 5%, but they won't tweak it much larger than that. But then there is again a section of fund managers who are looking for creating alpha. And for them, India is no more a basket case that they will allocate just 3.5%, 4%, but they want to go like, way overweight than what they have been previously on emerging markets. So for them, like countries like India present a very good growth opportunity. And currently, if you look at the case is very strongly building towards having a 10% allocation towards India of the entire FPI's FI corpus and being managed. So if that will happen, then again we'll be seeing a good inflows from the foreign side. But even if you take a base case scenario of 20, 30, $40 billion that we receive in a good year, right? So that does the case, and we see the market going up. But then again, in a bad year, we see the market being retracted when this FPIs and FIs flows goes away from the market. So for that, we have a very potent internal force which is countering the volatility in the flows, right? And which is the DI flows. And let's just understand how the domestic market flows have been behaving in the last few years. So like there are two or three parts to it, right, for the domestic flows. The first is the contribution from the PF side, which is your EPFO office, and then the other is the from the SIP flow side. So I'll just explain how the EPFO contribution has worked in the past. So that started in 2015 or 16 with a 5% mandatory allocation. Then it moved up to 10%. Today it's 15%. It has the possibility to go up to 20 and 25% also in future, right? The EPFO contribution. And it doesn't matter you understand as an investor, you know about equity markets or not. This is a mandatory allocation. Like if you're working, if your PF is deducted, then certain portion of that PF is going back to the equity market, right? So as and when the savings will grow, as and when the wages will grow, the EPFO contribution will also grow, right? And then the share of that contribution, the equity share of that contribution will also grow. So that's a one trigger that domestically will see this net positive flow coming to the markets every month, every quarter. The other part of the coin is your SIP flows. So just to draw parallels with what happened in US market. So basically, if you look at today, we are a $3.5 trillion roughly, right, dollar economy. So US was the same size, and US economy was the same size in 1972. In the next 18 years, and there also the mutual fund penetration was roughly around 350 odd billion dollars, which is same as India. And what happened? Equity mutual fund penetration. So what happened after that in the 18 years? The stock market in US grew by 18x, right? And if you also look at the percentage of equity mutual fund penetration, that has also gone up by 15% from 3.5%. So what we believe is that even if it's not that 50% mark that will be hitting, but again, if let's say we manage to get 30%, 40%, so the SIP flow will only getting stronger from here on. And the next 10 odd years, 10, 15 odd years, will see it to getting at a maximum potential of its flows. And the other side also of this is the savings that we are doing, right? So for example, today we are saving as an Indian household, today we are saving 30%, right? And if you look at the equity contribution of that 30%, it's just around 15%. Whereas if you compare to what US is doing, it's around 50%. So that equity savings percent is also have to go up. So all in all, like, we are very bullish that going forward, whatever the flows that we have seen in the past, the future flows in the domestic side will surpass all that, and that will create a liquidity scenario for the domestic companies. Now understand that 90% of those flows goes to your large caps, but even if the 10% of flows that will coming to the middle and small cap, that will create a lot of opportunity for the companies working in that space, right? And that's why we are very bullish. For example, just take last year when it was a weak market and FIs were taking out money from the market. So on an average, every month they have taken out 10,000 crore of money from the markets, right? But if you compare the net buying on an average basis every month from the DIA side, it was 1,300 CR. So on an average net basis, we have received 3,000 crore of inflows in the equity market, even in a bad year. So what it shows that, like, few years back, 5, 6 years back, we're heavily dependent, or the market was heavily dependent, and the cycles were highly correlated with US market cycles. But that has started to change. And in fact, in the bad year also, when last year US market was down 15, 16 odd percent, we have ended the year on a very flat note, right? So even with all the carnage and all the one-offs in the market happening, like Russia-Ukraine war and the yields hitting a 10-year high, the market has managed to close on a very neutral basis. So obviously there could be a drawdowns in the market. Nobody can deny that. And when the FIs will try to take out money from the Indian market, because they have also to manage for the liquidity in case of slightly riskier environments. So there could be a drawdown in the market, but that drawdown will be bought out by the domestic investors, and that will keep getting stronger because domestic inflows will always be net positive and it will never be negative from here on for at least next 10 odd years. So that's why we believe that we have a very robust domestic flows that will also be adding to the market growth. Now moving on, if you look at the fundamental reasons why our economy is kind of doing very well on ground, is because 2014 to 19, if you look at, we have a lot of reforms, right? So basically, starting with there was land reform, and then there was this GST, which was again rearranged, and then there was PLI, and then there are a whole lot of reforms, which was Labor Act was reformed, and then there was banking regulations and all, which was changed. But in spite of all that, right, the growth was not there, but the foundation was laid out for the future growth. So if you look at in the last 3-4 odd years, right, it's especially post your COVID. So if you look at the growth in terms of manufacturing, it has been commendable, right? So we have not achieved something of a great importance in PLI side, but what it has done is it has started the manufacturing wheel, right? And now because of that, we have started to seeing continuous investment being done in the field. Also, if you look at as a logistics cost to the entire GDP ratio, so logistics cost to GDP is roughly around 16% for India. If you look at the developed market, is hardly around 8 to 10%. So whatever the goods that we produce in the country, so that goods become typically expensive. And also the last mile connectivity was not there, so consumption of those goods were not happening. So government has mandated to bring it down to at least 10-12% so that our goods become competitive in the international market, and also those goods are locally consumed, right? So basically today the internet is there at the last villages in the country, and also there is a network of road, railways, and wires and cables which is being built. So just to give an example how far we have come, if you look at the roads being constructed on a daily basis 10 years back, it was just around 10 kilometers, right? But today, if you look at, we are constructing close to 35 kilometers of highways every day. And in next few years, like 2 years, so we'll be constructing 35, 40, 45 kilometers of highways every day. And that's a very big boost for the connectivity, which will be again very important for bringing down the entire logistics cost in the country. Right. So that is like few of the things which have done on a ground level, and that has led to a very good impact and a very long lasting impact on the economy as a whole. Now, moving on, just to understand some of the reforms pushed. So the best of it and the biggest of it was the cut in the interest rate, cut in the corporate tax rate. For earlier, it was 33%, which was on the higher side. But the real seriousness that government wanted to push manufacturing was come in when they decided to cut the tax rates. And the tax rate was slashed 25%, which was again lowest among the lowest tax rates along globally. And if you look at the incentive for the new players to put up factory, it was way higher. So their tax rate was again placed at around 15%. So for a company which is doing very good work, and they are generating more profit, so it gives them incentive to plow back the profit in the business so that they can reap higher benefit through the lower tax rates, right? So this has been a cycle which has at play, and it has done well for the country, and we are seeing a lot of companies doing capex. And the capex is not done through taking leverage. So the capex is done from the internal accrual side, which also shows the quality of growth of those companies is very sustainable and long term oriented. Now moving on, if you look at the exports that we are trying to do here, so mainly if you look at the exports that we are doing today in the electronics side, so the global share of the electronics export by India is just 5%. But because of all the push and then government program to regenerate and revive the manufacturing industry, especially the EMS side. So what we are planning or to achieve is that in the next 5 years, the our export share in the global electronics industry should go up to 10%. And what it will also do to other segment is that the merchandise export will go up to will clock a CAGR of 12%, or let's say totally in total we will be clocking a CAGR of 11-12%, which means that more of the money will be remitted, and the currency which is again a very huge factor, right? Because one of the two main problems for the country today is the imports that we are doing, mainly from the crude side, and also like the electronics import that we are doing. So today net we are not that weaker on the electronics import side, but again crude import is a big problem for us. So government is also trying to develop and set up the entire EV base in the country. So those things are done on a fundamental level and has played their parts. But like apart from the manufacturing thing, again other sector we are really bullish about is the the entire real estate sector and the infrastructure sector. So just to give you a context, in the last 10 years, right, in the previous decade, the US and the China has a very robust housing demand, right? But if you look at today, both of the markets, be it US or China, both the markets are struggling. Prabhu, you can move to the next slide, please. Yeah, but if you look at the real estate market in India today, it has started to move up, right? And also the government has given a mandate, in the budget, that they will be doing a capex of 143 trillion from FY24 to FY 2030. So that will be a very big push for the infrastructure side. And also, if you look at the kind of housing demand that we are having, it's coming after almost a decade, right? So the housing demand is very good. The infrastructure segment, mainly because of the government capex, is doing very good. So what it does is that, if a new income class joins the economy with, let's say, 15,000 rupees of monthly income, and they keep on spending they keep on expanding. So mainly it will again add in like 2,000 to 3,000 more people who will be supplying goods and services to them, and then that will again lead to the multiplier effect on the economy, which will again boost the GDP in a very big way, and again it creates a feel good factor for the entire economy. So we don't want it to play that theme directly through some real estate companies or some through infrastructure companies, but what we have identified studying the cycle is that it's better to play through the ancillary and auxiliary means, right? The company was supplying to the infrastructure companies and, let's say, the housing companies. So we have some sort of case studies to also to discuss with you, but more of that from Vijay. So I'd like to invite Vijay to discuss the next two sections of the webinar. Yeah, over to you, Vijay. Now.
Yeah, thank you, Prabhat, for taking us to the macro landscape side. Now that we have established that we are moving towards a $5 trillion mark in terms of GDP and eventually a $10 trillion mark on the India growth story side, so naturally the question comes to our mind, like which will be the winning sectors in the next decade. So to understand it better, we need to go back to the demographic profile, that how the demographic profile will shape up in the next decade. So on the left side, if you look at the household income distribution and the GDP per capita mark, so currently we have around 30 crore odd households in India. Our GDP per capita is around 2.27K, which is $2,200 odd. And if we look at the distribution of the household on the y-axis side, so we typically see the around 75% of our households have less than $10,000 mark GDP per capita kind of income. So that is how the distribution is. And if we look at the 10 years down the line, how the distribution will shape up, or let's say how the household distribution will completely revamp. So the bottom two portions are there. That will shrink almost from 75% to only 47%. The major shift will be the people or the household will be pushed towards the $10,000 mark. And if we combine the above two scenario, which are the 53%, which are the households which will be earning, or let's say which will be having more than $10,000 GDP per capita kind of income per mark, and our GDP per capita will move up from 2.27K mark to almost 5.24K mark. So we will see almost 2.3x of the GDP per capita. Our income distribution for the household will also move up, which is below $5,000 mark for the 75% of the population. That will shift to the $10,000 mark, that it will cross it, and around 53% of the households will be earning more than $10,000 per year per annual side. So this shift in the demographic profile and the income profile and the GDP per capita profile also will shift the consumption pattern. Also, it will change the consumer behavior. To understand it better, we have also studied the various geographies. We can move to the next slide, please. So what we have done was like we studied the various economies, which developed economies especially, which have already traversed this journey when they were at the $2,000 mark, when they crossed the $3,000 mark or $4,000 mark and 5,000, and eventually becoming more than $10,000 mark GDP per capita economy. What we saw in terms of their consumer pattern, there were significant boost to three sectors. We have noted down various sectors like real estate, credit, retail, mobility, electronics, durable items, or recreational activities, or retail side or credit side. But if we look at the three major sectors, if we have to pick which got disproportionate tailwind or which got disproportionate boom because of GDP per capita crossing this $2,500 mark, these three sectors was first was the real estate. We can name it infrastructure, or somebody calls it a construction, or let's say the housing market. Second is the consumer discretionary, people spending on the discretionary products once they have satisfied their necessary items or necessary foods that they want for their living. And third was the finance, which is required for boosting the consumption and the infrastructure market. So these were the three clear winners. And why this is happening, that these three sectors are getting pushed? Because as our GDP per capita moves up, typically the people's income also will increase, as we have seen in the previous slide, that it will cross people will cross $10,000 mark on the majority side, and people will feel more certain of that future income, and they will start to borrow against their future income, and they will start purchasing their own homes. They will start going for, let's say, the from rented, the shift will begin to the owner own house side. People will also start spending on the discretionary products like branded apparels, branded mobiles, or branded electronics, or even going for some of the recreational items, or buying luxury products, let's say the some premium cars, and even the holiday side and the vacation side. So these things will get disproportionate because of the underlying shift which is happening due to the income distribution is changing for the overall level side. And now we will crystallize the number, like how the our economy will shape up in the, let's say, next 10 years mark. So if you look at the nominal GDP, as of now, it's around $3.2 trillion mark as of FY22. And what we envision in the next 10 years of down the line. So these are very conservative estimates, around 9 or 9.5% CAGR, 9.6%, and we are expecting it to around $8 trillion. These are very conservative estimates. We are hopeful like we will surpass these numbers, and we will be at least growing at a double-digit mark on the nominal GDP side. Our GDP per capita will grow up from 2.2K mark to almost 5.2K mark. The consumption, which is around $1.8 trillion right now, it will become around $4.5 trillion mark. And if we divide the total consumption in two parts, which is a retail market and non-retail market. So our retail market is around $781 billion, and the non-retail market, which is automotive, leisure, hotels, and education and health, it's around 1.1 trillion. So we will see it ballooning to 1.8 trillion in terms of the retail market, and 2.7 trillion on the non-retail market. And they will also grow in line with what we have experienced in the GDP mark. But the magic will happen in the basically the grocery retail and the non-grocery retail. So basically, grocery retail is the necessary products that people consume for the survival, which is essential for living. That market will grow from $500 billion to the almost like 1 trillion mark, which will grow at around 6.5% CAGR. But if we look at the number, which is $282 billion for the non-grocery retail, which is a discretionary market, that will grow at a 12.2% CAGR mark, and it will almost move to the $900 billion mark by FY32. And it will almost triple in the time, and it's growing at the pace of 1.3x of the nominal GDP. So typically, a emerging company or the leader in the particular industry in the consumer discretionary side can easily grow up to at least 1.4 or 1.5 times of the industry growth, which is a 12% for the discretionary side. So that is how the allocation will shift from more towards from necessary products to the discretionary product side. And the whole housing basket, as we have seen in the previous slide, will also trigger the shift in the consumer behavior side. Then this is how like we have crystallized there. These are the numbers that we can expect our economy to shape up in the next 10 years down the line. The winning sectors will be the first will be the housing or the real estate or the infra side. Second will be the consumer discretionary item, and the third will be the fuel, which is required for this above sectors, which will be the finance. So that is how we have crystallized these three sectors. Now we will move on, like how we can pick the winners, or let's say how we can identify the businesses from these sectors that can help us to grow our wealth, or let's say that can benefit to our investors as well. So some of you who are regular attendees of our webinar series will be familiar with the multi-bagger framework that we have developed, and we have been vocal about it from the long time. So this framework has two legs. First is the growth, second is the value. So in the typically growth side, we look for the businesses who can double their earnings in, let's say, next 3 to 5 years period of time. We look for the business which can grow, let's say, more than the industry growth. Like I mentioned in the previous slide, the 12%, 12.5% is the growth we can expect in the consumer discretionary side. So we will typically look for business which can grow, let's say, the 15 or 16% on the top line side, and they should double the earnings, let's say, at growing at least 20% CAGR in the next 4 to 5 years time. Second leg will be the valuation. So we will also look for the businesses which are trading below the industry multiples, or which are trading to the discount to the leader as well. So let's take example of the paint sector, where the whole sector is trading around 70x P on the trailing 12 months valuation. Leader is trading around 85x P, which is the Asian Paints or the Berger Paints. So we'll typically go for the company which is trading, let's say, discount around 40x or 50x P on the trailing side, which is which is at a discount to the industry multiple as well, on the leader multiple as well. So what it will help us, it will give us the margin of safety. And in case something is going wrong, so because of the valuation, let's say the lower downside, we'll be able to retain our capital more. And this will also help us, let's say, when the business is growing, doubling its earnings in the next 4 to 5 years, we will also see the multiple, which will be around 35x or 40x P to, let's say, swell up to 70x or the 50x P once the journey from 4 year to 5 years passes. And that will lead us to the 2x return, let's say double of the earnings, and let's say the valuation goes up from 30 to 50x P, will also grow by 1.5x in the PE side. So if we multiply 2 into 1.5, so we can at least expect 3 to 3.5x kind of upside in particular business that we are picking in the next 4 to 5 years. So that is how the framework has been. And to take a little bit deeper that how we actually understand or study the business, we will move to the next slide. So what we typically do, the style is basically, as we have seen, the growth at reasonable valuation, 2 legs, growth and valuation. When it comes to the investment thesis, it has 2 legs. First is the business analysis, second is the valuation, and followed by the risk management framework. So in business analysis, so whenever we are screening for any particular company, so we'll look at the past numbers, we'll study the annual reports, we'll look how the company has built up over the years, and we will try to identify the source of competitive advantages. Like we will look for the moats. Is it a narrow moat? Is it a wide moat? Is it a pricing power? Is it a switching cost? Is it the intangible assets? Let's say it's the network effect. What is the source of moat that the company has been able to compound its earnings, let's say at the 20% or 18% at a higher return on capital employed mark for the last 5 years or 10 years down the line, in the last 5 years. So that will the moat study. Then we will also schedule a call with the promoter and visit the plants in some cases where it's necessary. We'll understand from the management how they will shape up the business in the next 5 to 10 years. We'll also run our forensic checks, like in terms of the promoter quality check using indiaqanun.org, where a lot of legal issues, if there is any pending against any particular company or let's say particular business or any particular promoter, will come to know. And that will help us to identify, or let's say avoid certain businesses which are not passing through filter criteria. This is how our business analysis works. And once we have conducted this business analysis, we will look for the valuation that the business is trading in the public market, which is the exchanges basically. And if we think that the market in the business is trading it is at a substantial discount to this fair value, then we'll go and purchase the business. If the stock is trading above its fair value, or let's say our guardrails which we have defined, so we wait for the business to correct and come into our margin of safety area, and then we'll pick the position in the particular stock. And that is how we pick around 25 to 30 businesses diversified across various industries, and we run the portfolio. So that is the first part of our investment thesis. Second part that I have mentioned is the risk management framework. So at RH, we strongly believe that risk and return walk hands in hand. So we'll also look from the risk management perspective, like which are the business, which are the risks that business can have, and it can derail our investment thesis. So basically, we have identified 3 different sources of risk. First is the business risk. So we typically avoid businesses which have unpredictable earnings. So let's say which have a cyclical earnings, or which have a, let's say, the competitive advantages are very narrow or they are declining mode side, because the compounding will not happen once the competitive advantages have started to go down. Second is the valuation. So we never pick businesses which are trading about this fair valuation mark, because it destroys your margin of safety. Third is the corporate governance, which we highlighted. We don't like management which are not the minority shareholders friendly, which believe in the misallocation of the capital, and they are not transparent with the mistakes that they commit. So these are the three sources of risk that we keep track on. And these three risks have also enabled us to avoid the pitfalls and help us to preserve the capital and grow in the bull market side as well. And with the same thing in the mind, the investment framework that we have discussed, we have also developed our portfolio for the upcoming bull cycle. Now we will just have a look like what the theory looks like in the practical or the reality that we have put into the portfolio side. Yeah. So these are the different sectors that we have bet on. So typically these are the underlying theme is the construction or manufacturing or infra or the consumer discretionary, as my colleague has highlighted, as also I have pointed out through the various data points. But you will typically find it that we are not playing it through the, let's say, the any EPC player, or you are not finding any real estate player, or let's say the any builder kind of entity that we have taken a position in. Why? Because of the very simple reason. So we have studied those businesses in very in depth for the in the looking at the numbers for the last 2 decades, and we have identified five major issues with those business model. The first is the cost overrun. So whenever any, let's say, the project management company, or let's say EPC player, let's say it wants to build a power plant, so it's not like it cannot correctly predict that what will be the cost for the particular power plant to develop, because there will be always some issues, or there will be always some unexpected, or let's say unpredictable issues coming, and it will not be the forecasted as per the plan, and the theory will always be a different compared to the execution. So there will be certain challenges which will increase the cost overflow. Second will be the time overrun, as we have seen in the multiple slide. Like these are the very bulky projects. It requires a lot of manpower, and there are a lot of things which can go wrong. So it will lead to the cost, time overrun apart from the cost overrun. And these two things will also increase your working capital, which is the third major problem for these companies, because your time is not timeline is not fixed. It's a variable. Your cost is not, let's say, highly predictable. Your working capital originally predicted will balloon up, let's say, 2-3 times, and you will end up taking debt, or let's say borrow from the different institutions. That will culminate into the fourth problem, which is the poor balance sheet. Your ROE will get destroyed, your ROC will get destroyed. So what we typically have seen, these companies go up very sharply when there is an order book build up, or let's say the order win happens. But when the execution happens in the next 3, 4, 5 years, 6 years down the line, the execution typically doesn't go as per the plan or as per the prediction of the IRR that the EPC player or the building material player has committed. It always goes to the, let's say, the overflow side, and it destroys the ROE and ROC mark. And the fifth one, which is typically for the any EPC player which are executing the government contracts, is the regulatory hurdle. So whenever there is a government change or there is some policy change, so the older project becomes unviable some of the times. If we take example of the power plants, let's say the power plant assets which are built on the, let's say, the coal side or the traditional fuel side, now they are facing risk of the green energy power plants. So basically the projects that were looking at the very attractive from the IRR perspective, now they will suddenly become unviable because government is pushing for the green energy side, and the whole project will also get destroyed. So that's why we avoided this kind of company when we were making this portfolio. In our strategy that we manage is the RH super value, and we went for the companies which are avoid, let's say, which have been, their business model is devoid of this kind of risk, and they don't face this kind of issues. And because of that, because they get money in 50 to 60 days max from the EPC player, which is a second order derivative, the companies have very decent ROE and ROE, and which have been able to expand their multiple and have generated manifold returns for the shareholders as well. With these things in mind, we have picked our businesses from steel pipes, wires and cables, paints, PVC pipes, laminates, and the NBFC, which are coming from the real estate, infrastructure side, consumer discretionary side, and the basically the finance side. And depending on the various parameter, I will just take the example of the wires and cables company. Our company is trading around 43x P, sector multiple is around 52x. So we can expect the discount around 17%. We expect the earnings to grow up at least 2.5x in the next 5 years or period of time. and we can expect the company to go up at least 3 to 3.5x in the next 5 years. Similarly, for the PVC pipe company that we hold, it's trading at a 55% discount to the sector leader. The earnings are handsomely going to double or 2.5x as per our projection. And P will also exponent from 35 to 80. So doubling of P, doubling of earnings, we can expect at least 4.2, 4.5 to 5x kind of compounding for the particular business side. So that is how we have identified, and we have diversified our portfolio from the various industries, because we believe there will be always 20% of the investment thesis which will not play as per our expectation, and that is why we have diversified our tail to 25 or 30 stocks from the various sectors that we have highlighted. And lastly, the results, the efforts that we have put in since we have started managing this scheme. So if we look at the past performance for this particular scheme, so in the last cycle also we had different sectors in our mind. The basically the chemical sector, or let's say the consumer discretionary sector, especially from the EMS side. That has also generated us substantial alpha. And also for this sector, just the beginning of the cycle, we have also delivered solid alpha in the last 6 months. But if we look at the long-term return, that's what we typically believe when we look at it. So if we look at the, let's say the 5-year mark, or let's say the 3-year mark, so the RH Super Value has been the top performer in the mid-cap segment, not only on 3-year side, but as well as on the 5-year mark as well, which is a substantial achievement for us. But we stay humble enough, and we look for the pitfalls that can happen from the risk management framework side as well. And if we look at the absolute price comparison, so 10 crore invested, let's say somebody has invested 100 crore around November 20, it would have become around 263 crore, generating 40% CAGR, which is almost double of the BSE 500 TRI mark, which is a 19% CAGR for this strategy. So in a nutshell, we strongly believe in the India growth story. It will not be a like 2-3 year kind of trend. It will be a journey of multi-decadal wealth creation journey. In our humble opinion, we believe like mid-cap and small-cap businesses especially are better placed to play this cycle. And it will have its ups and downs, but the journey at overall level will be very rewarding one. And if anyone wants to be the part of the journey along with us, please feel free to reach us and join us. And with this, we would like to conclude this presentation. And thank you everyone for listening us patiently on this Friday evening. Thank you, ladies and gentlemen, and over to you, moderator. Yeah.
Yeah, thank you, sir. So now we'll begin with the Q&A session. The first question, so what could be the downside risk for Indian markets because of Arab countries, joining the war?
Yeah, Prabhu. Yeah. So basically, we have seen that happening also last year as well, when there was a conflict between Russia and Ukraine, right? And if you look at the year to date return after maybe 1 year or 16, 18 months down the line. So our market is up around 22 odd percent from then, right? So there could be a short-term volatility. There could be a crude spike, which is again a big negative for us. And in a case where the crude will be moving above $100 mark, right? So that could be a negative for us, and we can see a short-term outflow from the market, and we can see dollar index in the strengthening and also weakening of the domestic currency, which is again a next level trigger for the FIIs to pull out money more from the market. There could be a flight to safety as well. But just like what I've mentioned, the domestic flows are very strong, right? And if we are patient enough to wait for 7-8 months, then whatever the drawdown that we'll see, that will be bought out, right, by the domestic investors. And the chances that it will not be a long-term kind of event, because we have multiple like this. So I think we have already circulated Prabhu creative also on the same. So if it's possible, you can pull it out. Yeah, right, the same one. So there are multiple instances in the past also where either we are directly engaged in the activity of war or some other country. So maybe in 1991 there was a Gulf War, and even after that in the period the market was up around 15%. And this is all the data for domestic market. And the very recent was the Russia-Ukraine war. So war has a tendency to have an effect on the market, geopolitical tension for a very short period of time. We can see a drawdown, but over the period of time, it will not have any material impact. So today also, if you look at the Russia-Ukraine war is going, but we are not no more talking about it, right? So the focus is mostly on how the inflation will come down, when will be the rate cut happening, how the growth will be coming in the future quarters. So those are the main long-term things which will dictate the earnings and also the stock prices and the valuations, and not the war. In fact, any short-term the correction in the market is a good buying opportunity because we are very much bullish on the small and mid-cap side of the market. Because typically it behaves in a cycle of 3 to 4 years, and the cycle has just been 6 months old, right? The recent cycle that we have started to see. So for the next 3 to 4 year, the small and mid cap, we are very bullish that we'll see the multiple expansion happening once the rate cut will happen. We'll also see the earnings compounding at a very healthy pace going forward. So all in all, any correction in the short term could be a buying opportunity. Yeah.
Yeah, thank you, sir. So the next question is, how long will the infra story play out, and can we take exposure through real estate players?
Yeah. So I would like to take this question. Yeah. So, Prabhu, can you please once again repeat the last part of the question? Real estate, you mean?
Yes, sir. How long will the infra story play out, and can we take exposure through real estate players?
Yeah. Yeah. Thank you. Yeah. So basically, the infra story will not be a, let's say, the 2 year, 3 year, 5 year kind of trend. These are the multi-decadal, let's say, the 3, 4, 5 decades of trend. And if you look at the, let's say, the developed economies, so the infrastructure boom typically lasts more than 4 or 5 decades on the longer side. And then is again the replacement cycle for those infra assets that have been built for the older period of time. So this infra cycle in it's a virtuous cycle. The older assets will be replaced. These are the long asset cycles. These are not a 1 decade, 2 decade kind of trend. So this infrastructure will last, in our humble opinion, let's say 3, 4 decades for India as well. And because of the higher number of population, this can even last 5, 6 decades in the foreseeable future of time. And it will have its ups and downs, like it will be like a capital expansion. Let's say the capex will be slower from the government side, but the trend will be in the upside only for the foreseeable future. Coming to the real estate side, the taking through any EPZ exposure, or let's say the buying some real estate player. So as we have highlighted different pitfalls that these business models have, like the cost overrun or time overrun, or let's say the working capital issues, ROE, ROC being lower side because of the working capital issue and the unpredictability of the regulator changes from the government side. So I would just like to highlight one example from the only yesterday only, like we were going through the CGD news, especially in the NCR region. The government has mandated like by 2030, like majority of the even the vehicles, like 100% of the cab aggregators should move to the EV based vehicles or automotives only. So they are not even like let's say pushing the CNG led vehicle as well. So now the CNG consumption has also come into that, let's say, pitfall. Earlier only the fossil fuel was concerned. So these kind of changes are always happening, and these are very unpredictable from the government side. So typically the 5 risks that we highlighted are very significant for any real estate or the EPC player. And there is always cost overrun, time overrun. So your ROE and ROC will not be as what you highlighted in the longer run. So if you look at if I take the example, let's say the wires and cable company, who is, let's say, supplying the wires and cables to, let's say, the some power station, or let's say the power plant project. So what they typically will do, they will supply in trenches. So let's say some EPC player which has won the contract from the government side, and it is building a power plant. So they will place order with, let's say, the one of the company that is on a portfolio, which is a polycab. The polycab will supply the cables in the trenches. They will wait for, let's say, next 40 to 50 days with the player, whether they are returning money or not for the earlier shipped products, or let's say earlier provided product. And once they receive this product, then only they will go for the second tranche of the delivery. So these players, which are the ancillary players, they get typically the early payments. Okay, if we look at the data days for such kind of companies, it's around less than 50 days, even from the institutional point of view. So there are no working capital challenges. But if this EPC player has to recover the amount from the government, so it can take around, let's say, 6 months, 1 year. And if there is an election for, let's say, state level or central level, then sometimes it can even go to 2 years. Like even we have seen in the Corona times, the some players have been stuck with the government for around 2.5 to 3 years, the same capital which they had to recover from the government. So that destroyed the balance sheet of these businesses. And similar thing happens with the real estate player side. Because of the cost and time overrun, their ROE and ROC, which look good in the first year, they don't look when the order is completed 5 years or 6 years down the line. because these are long gestation assets, and the IRR prediction is very low, the predictability of IRR. So in our humble opinion, like one can consider the risk reward benefit. If one wants to play the let's say the real estate player, one can even cover the building material or that we have been talking about, like different wires and cables or the paint scheme, which have a higher predictability of earnings and better cash flow management on the micro level side as well. So one can look at the risk reward in both the execution, or let's say the EPC player or the real estate player versus the second order derivative players that we are favoring. So that is how one can think in terms of risk and reward only. Yeah. I hope that answers your query. Yeah. Thank you.
Yeah, thank you, sir. So the next question is, what is the minimum amount to invest in PMS, and will there be an impact to growth if a non-BJP player comes to power in 2024?
Yeah. So the minimum investment for any PMS as per SEBI mandate is around 50 lakh. So that is common across the every PMS entity that works under the SEBI mandate. So it's the same for us. Coming to the political scenario or the government side, so if we look at the last 75 years of the journey, or let's say 76 years of the journey, so there have been various governments, and if we look at the GDP, so once we had GDP of let's say $500 billion, now we have GDP of around $3.5 trillion. So that GDP has grown under the various political parties. We have seen like coalition government. We saw some good years of Congress. We saw some good years of BJP-led government. So governments on the typical side, on the small period of time, they will have some impact on terms of sentiments, but the sentiments are quite different from the fundamental side. Yeah, if I give example of say, let's say the wires and company, wires and cable company, that is in our portfolio. So that is not doing the capex from the point like the let's say the government will come or not, the same political party. They are doing the capex from the next 10 years point of view. And even the infrastructure assets which are built in India, these are not built from the perspective of let's say 2 year, 3 year, 5 year down the line. These are built over the let's say the 50 years or 60 years of the age, or let's say the total depreciable life. So these assets which are built, they are built from the 5 decades or 6 decades kind of perspective. If we talk about any real estate, these have like 30 to 35 years of expected life cycle for any real estate project as per ERA mandate. So these are all long gestation assets. The consumption intensity of the growth can vary across the various political agenda, but the direction will be always on the upper side. So we don't see any material damage happening to the stock market side if there is some political shift. Of course, there will be some sentimental effect which will come from the let's say the FII profit booking or the DII profit booking. That will, in our humble opinion, will be opportunity to top up the portfolio or buy aggressively, because those are the points like you will get the most crushed away valuation, or you will get the prices which are uncertain, or which the stock prices have come down because of the fear, and that you get the good prices. And eventually 2 3 years down the line, when the execution happens on the particular business, the same stock will get re-rating, like it happened with the Ukraine Russia war. Our if you look at our own portfolio that we have been managing, so from March itself, March 2023, the portfolio is up around 45% in the last 6 months. But the businesses were operating in the last 1.5 years. There was nothing magical which has happened in the last 6 years. It's the perception of the people that have shifted in the last 6 years, 6 months only. So the sentiments can change sharply, but the fundamental trajectory will remain the same. And as a fund manager, it's our job to track the fundamental change over the sentiment. So we don't see any material shift happening on the fundamental side, barring some sentiment dampening in case for short-term perspective. Yeah.
Yeah, thank you, sir. So the next question is, what is your view on the defense sector, and will that be a long-term trend?
Yeah. So basically, currently, if you look at the stocks from the defense side, so the valuations are already quite stretched at like what they're available 1 year back or 1.5 year back. So basically, because of the entire escalation and the scenario, the Russia-Ukraine war, so the stocks have already been discounted, like already been discounting future earnings of 4 or 5 years. And most of the stocks, if you look at from the defense side, so these stocks have long order book, right? So they continue to win the order, but if you look at the actual earning that the companies will be realizing, it's still 3 4 5 years down the line. And then between that period, there could be a lot of mismatch between the kind of earnings expectation, the valuation that the stocks are currently trading. So basically understand one set of re-rating happens when there is the order win. And then after that, till the earnings are realized, the stocks has to move sideways soon. And then when the earnings come, the EPS goes up, and then the PE comes down. After that, if that cycle keeps on happening, the new order win book and the improvement in all sort of ratios and all, so then we see the next level of multiple rating happening. So for now, we are staying away from any defensive stocks. Again, the thing is that we have added one stock actually, but it's not directly a defense stock, but mainly ancillary play, where it's selling the spare parts and it's from the SMA listed side. So that's also one of the flexibility with us, that we can add stocks from the SMA listed side because of our small size of the fund, right? And we have added the stock, and we expect that stock to deliver at least 5-6 kind of earnings growth in the next 4-5 years. So the opportunity is there. You just have to find the stocks at the right valuation. If you are finding a stock from the defense side also, which is trading at a very reasonable valuation and have a good prospect, in terms of, then go ahead and buy. But the entire pack seems very expensive now, so we try to stay away from it.
Okay. So the next question is, what would happen, in case the sector P comes down, or if there is a derating as a whole?
Yeah, the sector P comes down for the slide that Vijay presented.
Yes, yes.
Okay. So
Yeah.
we understand there could be a risk to the sector, right? And that's why we are not married to the stock, or we don't keep holding the stock for forever, right? So you understand, in the last cycle as well. So we entered the stocks at a point where it was very lucrative. It was trading at a discount to the industry. Once it has gone up, right? Once the stock is discovered, so the stock multiple actually doubles or becomes 1.5x. Then we continue to watch the earnings, right? And if the stock continues to show the earnings prospect, then we continue to hold it. The moment we see that there is some sort of a slowdown in terms of business, or the earnings are taking a hit, the margins are not as per our expectation, then we start cutting down the weights or take a call to exit the stock completely. For example, in the past cycle also, we have added stocks like JM Fodler, or Dixon. So Dixon is a very recent phenomena, right? When the stock P has hit a triple digit, we decided to exit the stock. Similarly, that has happened with the RCTC as well, right? So once we enter into a stock, we ride it through the multiple rating phase, the earnings growth phase, and then we feel that in the next 2 to 3 years, most of the future earnings are already discounted, or there are some macro headwinds developing which will impact the stock market as a whole. Then we try to exit the stock at that point of time. It's okay that in between that period, the valuation doesn't re-rate, because again, these are companies from micro cap side, small cap side, SME side, in fact the mid cap side also, where the discovery and the acknowledgement of the future growth by the street takes time. So we are patient with that, right? But if we feel that something is lagging from the company side, then we take a call to exit the company, because we have a lot of companies also in the whitelist that we have been tracking, and they are put there just on the observation side, that if we feel that tomorrow there is need to add some new company in the portfolio, we can add those companies.